Hey everyone, hope you all had a great weekend and had a great Monday so far today. For those of you up in Canada, it is election day, so if you haven't voted, go out there and vote. So, welcome to another edition of Money Monday. So, last week I was discussing the difference between personal and mortgage life insurance and just how I recommend that someone should have a personal life insurance policy rather than a mortgage life insurance policy. So, today I'm going to go over just how much life insurance coverage someone would have. So in this example, this is just taking into account the average client who's married, has children, and owns a home. Everyone's situation is different, and if you were to sit down with me, I'll always just give you an amount that's in line with your situation, taking your situation into consideration. So in this example, let's say Mr. and Mrs. Smith are married, and they have an average annual income of $60,000 a year. So we recommend that someone gets 10 to 20 times of their life insurance coverage. So at the lower end of that scale, that would be $600,000, and that money's going to be used to pay off debts and final expenses, as well as to replace income. So in this situation, it's not out of the realm of possibility to think that someone would have a $250,000 mortgage, and then with the average cost of funerals being about $20,000 and any other expenses like credit card debt, car loans, whatever, coming out to $50,000, that leave $300,000 left after that the debts are covered. So with that $300,000, someone could do one of two things. They could, or one of a few things actually. They could take that money, just go on a trip to Vegas, blow it all, or something like that. They could just use that money to replace the income, but $300,000, and if you're spending $60,000 a year, not taking inflation into account, then you could see that money would last only 5 years. What I recommend is that they would take this money and they either come back to me or any other advisor, and they would put it in a conservative investment and to generate income. So because it's a conservative investment to generate income, we normally say about 5% because I like to underpromise and overdeliver. So in this situation, with that 5%, that would generate $18,000 a year of income, which breaks down to just under $1,300 a month. So taking into account how the debts are going to be covered, mortgage, everything, and that's just going to help with the bills around the house, replace income while the spouse takes some time off to grieve, and then helps to cover childcare, children's education, all that sort of in the future. You got to think to yourself, is that something that I feel comfortable leaving behind for my family when something terrible were to happen to me? If you do think that, or you do want to get an assessment on just how much coverage you do have, always feel free to reach out to me, message me, give me a call, and I'm more than happy to sit down with you. Hope you all learned something today and have a great day.